All right, hope everyone's doing well. You guys had a good weekend. I'm just gonna mute everyone as well. We have some Q&A after. So yeah, usual disclaimer, guys. Everything discussed here is for educational purposes only. Do your own research, do your own DD. If you have any questions, obviously fire away. I'm happy to answer them. This week, data isn't that, thus far the data hasn't been that important. The market hasn't moved at all. And I noticed right now that I actually botched the image over here, so ignore that. But we do have the ADP employment report on Wednesday, nothing tomorrow. ISM manufacturing index is on Tuesday, and motor vehicle sales. Thursday, jobless claims, again, it hasn't seemed to matter whatsoever to the market. The market's just been going up, up, and up. And I'll discuss that in a second as well as it pertains to the Fed. Friday, we have NFP, non-farm payrolls, 8:30 a.m., and unemployment rate as well. So Wednesday and Friday should be interesting. Wednesday with the ADP employment report, and Friday with the non-farm payrolls, right? So looking at where we are right now, seasonality-wise, September is typically the worst performing month for stocks. Since 1950, the Dow Jones has averaged a decline of 0.8%, and the S&P has averaged a decline of 0.5% during the month of September. And given that we're at all-time highs across NASDAQ and S&P, it's a high probability event that we're going to see some kind of decline. I'm not expecting a huge decline, but given that we have the U.S. presidential election approaching rapidly, we're only 2 months away from that right now. I do expect increased volatility, and you can also see that on the VIX contracts for October and November. Also, increased risk of election results being contested due to a larger number of write-in ballots, right? That'll be a point of contention from Trump if he does end up losing. So that could also cause more volatility during November as well, which is why numerous experts have said that if you're going to play the election with options, you should buy a few weeks past the actual event itself. So November monthlies or maybe even December monthlies as well. Also, there is the potential for a second wave of coronavirus as schools reopen. That's also another risk factor as well right now. And then obviously tomorrow we have Tesla and Apple both trading post-split. So Tesla will be trading at 1/5 their closing price from Friday. Anyone who has one share or had one share on Friday will now have 5 shares at 1/5 the price. And for Apple, it'll be 1/4 the price and 4 times the number of shares. So I had a discussion with a few people asking me if I thought that was a bullish event occurring on tomorrow, given that people would be able to buy Tesla at a cheaper price and Apple at a cheaper price. And I mean, my perspective is kind of opposite of that, which is that anyone holding Tesla or Apple would be wise to take some profits. And given that they have a larger number of shares now, they can sell some of those shares, lock in some profits, and still be long the equity, right? So that's my opinion on that. Anyone who watched the Fed last week, Jerome Powell talking from Jackson Hole, he was, let me just make sure I'm recording this one sec. Yeah, I'm recording it, good. Whoops. He discussed a new thing called average inflation targeting, right? This is pretty important to understand because it will affect every American and a lot of people globally as well, because monetary policy is closely tied globally to what the US does, right? So first off, what is inflation, right? Inflation is a quantitative measure of the rate at which the average price level of a basket of goods and services in an economy increases over a period of time, namely each year, right? So again, I mentioned in the past that when we discuss inflation, it's all about, how much are the same goods and services we're paying for year over year increasing in cost or decreasing in cost. If they decrease, it's called deflation, right? So you're talking about, bread, eggs, milk, meat, energy, so on and so forth, right? Now, what is average inflation targeting, right? Instead of aiming to return inflation over the medium term to the target rate of 2%, which is the Fed's current mandate, the Fed wants to aim to return the average of inflation over some period of time to the target rate, right? So that means that essentially, over time, what will happen is the Fed will look back on the previous years and say, okay, we want our average rate to say 2%. If last year the inflation rate was 1%, we want it to be 3% next year, so it averages out to be 2% over the past couple of years, right? And that's not a great policy. It's not constructive overall, and I'll explain why in a sec. But how will the Fed do this, right? Well, the Fed attempts to influence the rate of inflation by setting and adjusting the target for the federal funds rate, which is the rate at which they borrow money to or lend money to banks, right? This tool enables the Fed to expand or contract the money supply as needed, which influences target employment rates, stable prices, and stable economic growth. If you want to watch a good video on that, there's one by Ray Dalio. If you go to YouTube and type in Ray Dalio, how the economy works, there's a great video on that. So I couldn't even explain it better than him, so I won't even try. Watch that. It's about half an hour long, but phenomenal video. Why is this important, right? Well, this policy has adverse effects on the poor and very beneficial effects on the wealthy, right? Because if you're rich and you own assets, if you own real estate, if you own stocks, if you own gold, right, for example, then what will happen if inflation occurs? Your assets will rise in price, right? Your house will increase in value, your property will increase in value. The market will go up higher and higher, which is what I discussed a few weeks ago about the market just seeing rapid inflation in asset values, right? That's where you're seeing these valuations just get out of control, not because the corporations are actually worth that much money, but because there's so much money out there right now and it has nowhere to go, right? All these pension funds, mutual funds, hedge funds, individual investors, they have nowhere to put their money, right? They're losing value by letting it sit in a savings account because inflation is still above the savings rate. So in real terms, and real terms means, so there's real savings rate or interest rates, and there's nominal rates, right? Nominal rates are what they're set at. Real rates are what you subtract the nominal rate from the inflation rate, right? So for example, if the nominal rate is like 2% and the inflation rate is 1%, the real rate is 1%, right? 2 minus 1, 1%, right? So this is very, very detrimental to most people because a lot of people don't participate in the stock market, right? There are, a small number of people that do in proportion to the overall population that participate in the market's growth. But there are a lot of people that live hand to mouth and have no assets. They're renting, they're living paycheck to paycheck. So this will cause the poor to get poorer and the rich to get much, much richer, right? Because the poor do not hold on to hard assets and they lose purchasing power and they're squeezed even further, right? The other reason why it's important is because if inflation gets out of control, the Fed has no mechanism in place to prevent hyperinflation, right? Since they can only really increase inflation by increasing the money supply or lowering rates further, right? And again, that's possible to go negative as well. But they cannot raise rates or constrict the money supply given that the levels are so high right now in the US, right? They're astronomical, right? And this will have the effect of causing stock prices to rise further and further and further and get valuations out of control. And who knows when the bubble will burst or what will cause the bubble to burst. But it's evident, obviously, as we saw on Thursday and Friday after his speech, the market went up again and again. It's up, I think, 5 days in a row now, or 7 days in a row now. It's up about 10% over the last month on S&P. So being long, I mean, well, it makes no sense whatsoever from a logical standpoint, given that valuations are so out of whack, and the PE on the S&P right now is about 30, which is double the historical average. Given the monetary policy of the Fed, I mean, it makes sense to be long hard assets, right? So stocks, real estate, gold as well. I'll be discussing gold a little bit more because I think gold's an important one to look at because that's much more attainable for many of us. Anyone who's not holding real estate because the investment required isn't as large. And there are ways to play it that are interesting. That can also yield you a nice rate of return as well, right? I'll discuss that toward the end. So the dollar is going to keep on testing new lows because of this new policy, right? The Fed basically said, we're going to be supporting the market and doing whatever it takes to keep inflation at around 2% as a target rate. But keep in mind, they can also move that target, right? They can say, you know what, we want to move our average inflation target to 3% or 4%, right? There's nothing stopping them from changing their target, right? And again, this is very dangerous for the overall economy, especially as it pertains to people that can't afford to buy higher priced goods, right? People that are living paycheck to paycheck right now, their earnings aren't going to increase enough to offset the increase in the cost of living. That's a huge issue, right? And again, I think back to, the French Revolution and what happened with Marie Antoinette and King Louis, right? And I mean, it's crazy to think about it, but we're already seeing these riots and protests all over the US. And if people are hungry and they can't afford to eat and they can't make ends meet and they can't buy property and they don't see a future ahead, they don't see the American dream, they see an American nightmare. That might be a tipping point beyond what we've seen in a long, long time, right? I'll stop right there, I guess, right? To keep it, from being too pessimistic overall. But again, if you own US dollars, and most of us do because we have to invest in the US market, you got to hedge somewhere, right? So you need an inflationary hedge. For me, that's gold or silver. And again, I'll discuss that as well. So gold could see further upside over here. We saw it top out at around 2000 and change a few weeks ago for the December contract. But I do expect it to start rallying into the election as volatility spikes, and especially if it looks like Biden's going to win, right? Which right now, I believe the polling is showing that he's in the lead. Earnings for the week ahead. We have a number of SaaS companies. We have Zoom, Fastly, there's Cloudera, CrowdStrike, MongoDB. A lot of these seemingly overvalued tech companies, right, that have very outlandish price to sales ratios, which indicate that they're very overvalued, but they're providing valuable services to the economy, especially in an economy right now where everyone's working from home and everything's being done remotely, right? What we're seeing is kind of the death of brick and
Hey,
mortar.
Nick.
Yep.
Nick, I don't think your screen is working for us. We're not following you. It's still on the Option Infinity welcome page.
Oh, is it really?
At least it is for me and somebody else. Yeah.
It is for me as well, Nick.
It is for me as well.
Damn it. Sorry, guys. I've been recording the whole time. So anyways, I'll just backtrack a little bit so you guys can see everything again. Can you guys see it now? Is it fine now? Can you guys see this or no?
Yeah, it's at the disclaimer now.
Okay, sorry. Yeah, so you have all the data over here. I'm going to post it on YouTube anyway, so you guys can watch it again if you want to see the slides. But here's the data for the week, the economic data over here and over here. Here's what I said about the September time frame, how it historically is a terrible time for stocks. The election as well should cause more volatility and also rising risk of results being contested due to higher number of write-in ballots and also possibility of a second wave of the coronavirus opening. Average inflation targeting, I already discussed this. I said most of it verbatim, so you guys can just read over this if you want to read over it again. Dollar again testing new lows. I discussed that. Gold possibly on a ramp back up with 3 nice weekly wicks to the downside right there, showing pretty good support around 1950. And earnings over here, right? So everyone's on the same page now, right? Like everyone's good for this right here. Everyone can see my screen?
Yeah.
All right, perfect. Thanks for letting me know, man. I wasn't aware of that. Sorry. Yeah, so earnings reports for the week of the 31st. I already mentioned those SaaS companies, right? They're trading at outlandish valuations, but they are providing valuable services, right? I mean, Zoom. We're using Zoom right now, right? Cloudera, CrowdStrike, MongoDB, Fastly, DocuSign. They're all doing very well right now because they're SaaS businesses that cater to remote work, right? So ticker analysis for the week. SPY, you have current price of 350.44, all-time high. Expected move for the week 505 or 1.4%. The PM for the week $7.13 or 2%. Upper move 357.57 and lower move is 343.31. Again, as Blake has pointed out a few times, the RSI on SPY is insane right now. So we should see some kind of pullback at some point in time. Right now, as I speak, futures are still positive. So we'll see what happens tomorrow morning. Triple Q NASDAQ ETF, current price 292.47, expected move 756 or 2.6%, potential move $10.18 or 3.5%. The upper move would be $302.65, and the lower move would be $282.29. For the Russell ETF, which has been underperforming the market, as you can see on this chart on the right side, it's been consolidating in a pretty narrow range between 160 and 155 for the last roughly 3 weeks or so. That could signal a break to the upside. And the current price 157, the EM 331, PM 460, upper move 160, 160, and lower move 152, 40. Ticker analysis from last week. So last week we saw 21 PM breaches, right, with 14 of them closing outside or above the upper PM, right? And this to me is evidence of volatility being underpriced, right? So what that means is that if you're selling contracts or for credit spreads, you got to be careful. You need to wait for the breach to occur and then sell outside of that range as well, right? Because obviously, as we're approaching the election, you're going to see volatility rise. You always want to be analyzing what's happening with implied volatility, right? When it's ramping up, you want to be careful about selling because you can get burned very fast, right? Conversely, when it's dropping in value, right? When you're getting an IV crush scenario or a decline in IV, that's when you want to be selling premium because you're going to get the fast Vega decay, right? The crush on the Vega, right? So just an interesting note right there. For the week ahead, again, thank you very much to Frankie again, guys. Say thanks to him because he's done a lot of work for this. The tickers that are reporting earnings this week on this spreadsheet are DocuSign and Zoom Meeting, and Docu has a potential move of 16.2%, so upper move of 250 roughly, lower move of 180. Again, I would expect them to do pretty well. Actually, one of my friends works for DocuSign, and well, he hasn't told me that they're doing phenomenally well because he can't tell me their sales numbers. He has said that they're doing overall like pretty positive, and he's doing well himself, right? So take that with a grain of salt, but that to me is kind of some decent information to go on. Again, the implied volatility is super high on it, right? So watch out when you're buying contracts because you can get burned very fast in the IV crush. And then Zoom has a PM of 16.6% or $50 roughly in one direction. So upside 348.65, downside 249.55. I do think Zoom is very overvalued, but again, I pay for it, right? So I know what a valuable service it is, and I also use it to teach as well, right? So great service, but there are a lot of competitors as well, right? As I mentioned earlier on, I would discuss GLD a little bit, which is gold ETF. So my trade idea for the week, and again, this is for learning purposes, guys. I don't recommend doing this trade. If you want to do it, do it at your own risk and understand what you're actually doing, right? But it's a poor man's covered call on GLD, right? So closing price on Friday was 184.70. Looking at the implied volatility skew, you can see that the November expiration is the highest IV skew at 22.2%. And obviously it's because of the election, right? If we have a crash in the market, you can probably see a huge spike in gold. And also possible decline in the US dollar as well. The 21.2% is a January expiration, and then you have September, which is the yellow line, and you have October, which is the orange line, right? Which are pretty similar overall for skew purposes. So the trade idea for the week is long January 15, 2021, 170 deep in the money call option, right? The net debit there, when you factor in a short call for the monthly OPEX for September 18th at the 190 strike, the net debit is about 1620 overall at the midpoint. So your break even on the trade would be the 170 long strike for January plus the net debit of 1620, which is 186.20, right? Your maximum profit prior to the September 18th expiration is the 190 short strike less your break even of 186.20. So you're going to make $3.80 profit, assuming that GLD goes above 190 at expiration for the September OPEX. This represents a potential 3-week return of 23.45% in the event that it does breach 190 by September 18th. If the 190 short strike is tested, the option to roll the contract forward to October expiration exists, right? That depends on your thesis on the trade. If you believe it's going to keep running or not, you can roll it forward, obviously, and generate a larger credit, thereby reducing your overall debit. If the 190 short call expires worthless, a short call for October could generate further returns while simultaneously reducing the overall risk on the trade, right? So that would be where GLD come 0918 is below 190. The September 18th contract expires worthless, and then on the Monday following that, which would be the 21st, you'd be able to sell the October contract out of the money again, pull in more premium, reduce your debit further. Again, you're probably gonna get more premium there because we're approaching the election, right? So you're probably gonna get a fair bit more premium out of the money, right? And then max loss obviously occurs below 170 price on the stock on GLD at the expiration of the January call, right? So that's the trade idea for the week. Again, poor man's covered calls are phenomenal ways to generate returns using less risk. Obviously, you're going to have higher dollar risk on each trade, given that the option contract on the leap is going to be more expensive if you're buying deep in the money. I'm talking like a 0.7 or 0.8 delta contract. You're going to be paying higher premium for that contract because it has a higher probability of expiring in the money. But that enables you to sell out of the money contracts on shorter durations against your position and generate a net, so you lower your net debit overall while simultaneously allowing you to have a possible nice profit if it were to breach the upside on the short-term short call option, right? And yeah, that's it for the week. Sorry about the mishap with the earlier part of the presentation, guys. Any questions at all? Anyone want to discuss anything at all? Anything at all?
Can you give a better explanation of like your position on gold for me again? Just want to get better notes on that.
Sure. You mean for the poor man's covered call?
Yeah, for gold, yeah.
Sure. Let me pull up a chart on that one sec, or the option chain. How do I get out of the screen? New share. Go over here. Let's go to GLD. So here's GLD's chart right here, right? You can see that the gap back from July 24th was filled. So it gapped up over here, and that gap was filled back on the 12th of August, right? And if we're looking at the option chain, so the idea here is that your break even for January is right at this base over here, right? That's your long contract over here, right? So again, I'll put a little note over here, right? So your long January 170 call, right? That's your break even over here, right? And I mean, sorry, not break even. That's your max loss occurs below this price range, right? But given that it based over here, popped up, had a nice big gap. There are gaps below still on GLD, but given that gold is a commodity, I don't really think about it like that in terms of gapping. And also given the current sentiment on the US dollar and what happened with the Fed last week, I think the USD is going to keep diving, which means that gold's going to keep on going up along with silver, right? So the idea would be that you believe it's going to keep going up into January, especially past the election. But at the same time, you want to generate income on your position, right? It's kind of like having an asset that doesn't give you a return, right? Like you won't want to buy a rental property and leave it vacant for 3 months, right? You prefer to rent it out for 3 months and collect rent for 3 months in a row, right? So if you're looking at GLD, the option trader, you open the option trader over here, right? And this loads up, one sec. Go to strategy builder. So the long contract is for January, right? You're going down to the 0.77 delta over here. I believe it's 0.77, I think it is. It's all loading right now for me. Either way. So your break even would be 170 strike plus your debit amount over here. So it would be roughly if you do midpoint of let's say midpoint is 18 here, then your break even would be 170 plus 18, which is 188, right? So why not generate some income on that position for the next 3 weeks, right? So in that case, you go long this contract over here, right? And then you go short the September 18th monthly contract. Keep in mind your break even is 188. So you want to sell contracts above that strike price in the event that you're assigned, right? So you're going to go above the 188 strike to the 190 strike. Again, that will have a delta of around, I think it's 0.24, I believe. It's not showing right now. I don't know why it's doing that, but either way, you're pulling in $1.74 credit over here, right, on your position. And if GLD were to pop above 190 over the next 3 weeks, keep in mind that next week, Monday is a holiday for Labor Day, right? So you only really have 3 weeks with one shortened week. So you have 14 trading days, right, for GLD to pop above 190. And if it does, you're generating a return of about 23% over the course of 3 weeks, right? So you're going to make on this on risk of one contract, you're risking about $1,620 per position, right? That's per one contract lot, and you generate a return of $3.80 on your position. So if you do 380 divided by 16.2, it's 23.45%, right? That's how much you're making over the course of 3 weeks roughly, right? Keep in mind, if it expires below the 190 strike, this expires worthless. You're still holding your January contract, and let's say it's trading at 188 or something like that come 0918, right? Then that would allow you to sell the October OPEX if you wanted to, right? Again, minimal maintenance. If you're looking at October OPEX, factor in that you're going to get a higher spike probably in gold due to higher volatility in the markets because of the election approaching, right? So you can probably sell the 195 strike even if you wanted to, or even the 200 strike potentially, right? And again, you're pulling in $1.60, or you're pulling in, $2.40 at the 195 strike, or if you want to do the same strike again, you're selling a higher delta contract, which means higher probability of expiring in the money, but you're pulling in more premium, right? If you sold this, for example, after you let this expire worthless, the 0918 contract, and you pulled in, let's say you pulled in, got to factor in time decay of another. Would be time decay of 19 days at theta value. Let me see what theta is right now. Again, it's not showing up right now, but about 0.06. So 6 days theta value. Sorry, 6 cents of theta value decay per day times 19. So you're looking at $1.20 of theta decay roughly. So you're probably going to see this down to around 240 come the expiration at 0918. So you could sell this for 240 potentially if you wanted to, and then you're pulling in an additional $240 on your position, and now your break even goes from 1620 down to, subtract 240 from that, it'll go down to 1380, right? So then your break even would be 1380 plus the strike price of the January contract, which is 170, so it'd be 183.80, right? And then keep in mind, assuming that it's say below 190 again for October, which I don't think will be the case. I think gold's going to keep on spiking. So you probably want to go out of the money, probably to the 200 strike and pull in less premium, keep more upside. But let's say that you're happy with that return. You pull in an additional 240 right there. And if you were assigned on the 190 contract, your break even is, your debit is 1380, and you'd pull in 20 minus 1380 is 620, and divided by your initial investment of 1380. Your return for over 2 months would be 44.92%, right? So that's pretty damn good return, right? And then obviously, if your October OPEX expired worthless, you then sell the November OPEX as well. And then if that expired worthless, you sell the December OPEX. And then for the final month, which is your January OPEX, you would sell the same month, turn it into a spread, or you could roll it forward if you wanted to, if you're still bullish on gold, right? And essentially, it's like not a perfect trade at all. It's just more of a trade to look at to educate you guys on how a poor man's covered call works, right? Because think about it, if you're generating, on an investment of $1,620, you're generating a return of, let's say, $380 in 3 weeks. That's a pretty good return, right? Like imagine buying a rental property. Let's say you bought 10 contracts right here, right? So you spend $16,200, and in 3 weeks you're pulling in, $3,800, right? That's a phenomenal return. Like where else are you gonna get that in the market, right? I mean, you can definitely find it and risk your assets, but this is probably a more stable trade to take given the stature of the US dollar right now, right? Does that make sense, Ty?
Yeah, thanks for the clarity.
Yeah, no problem.
Yeah, makes sense to me.
Pardon?
Makes sense to me.
Awesome. Any more questions, you guys?
Hey Nick, you said you were about to talk to Silver as well. How are you? Good to hear you, brother.
Yeah, man.
It's Jose.
Hope you're doing well, man. Hopefully your wife's doing better, man. Silver, I haven't looked at too much. I prefer gold, but if you want to look at SLV, you can find the exact same kind of trade on SLV if you wanted to. And this might be a cheaper trade for anyone looking for lower exposure dollar-wise, right? Again, you just look at the same position. So SLV, if I pull up the chart on SLV, which is the silver ETF, right? So GLD is the gold ETF. SLV is a silver ETF. Here's a chart on SLV, right? So you can see that it's kind of forming a bull flag right here, or a kind of, I guess, triangle, if you will, right? I know Joel knows about those right there. But so if it keeps on breaking out to the upside into the election, you can see maybe a 30 tag, right, on SLV. So a cheaper trade would be to look at SLV, given that it's a cheaper underlying. And if you look at the option chain, the same exact trade can be done, right? So again, you go to January OPEX, right? You look for a 0.77 or a 0.8 delta. I'd probably go for the 0.77, given that right here you have a crazy amount of open interest, so your slippage will be nominal on the spreads. So you go long here, right? You're paying $8.20. It'd be about $8.15 midpoint, right? So your break even would be $20 plus $8.15, $28.15. Currently, it's trading at $25.55. And then if you want to sell out of the money contracts, you need to sell above the 28 strike price to generate a return, right? So you'd sell the 29 strike price or 28.50 if you wanted to, right? I'd probably sell the 29 strike price. You would sell this right here. So your overall risk is like let's call it 780, right? So your break even is 20 strike price plus 780, so 2780, right? And if you were to be assigned, you'd be assigned to 29. So you make 29 minus 2780, which is 120 bucks. So you make 120 divided by 780. You make a return of 15.4% over September, right? So not as good as a GLD trade. There's a lot of feedback on your mic right now. I think it was it, or it might be Chase. I'm not sure. But yeah, same idea with the trade, right? You just roll it forward to October, then November, then December, then January. And again, your maximum risk is whatever your debit is. Your break even is your strike price on your long plus your debit amount, and your maximum profit, for the duration of the short contract on the monthly OPEX would be, whatever the short strike is less your long strike. So in this case, it'd be 29 minus 20 minus your overall debit, which is $7.80, right? So you'd have upside of 120 bucks to make over the next 3 weeks. So not as juicy of a trade, but less capital required, because obviously you're spending $780 versus spending, $1,620, right? So it's less than half the investment required, right? If you wanted to go deeper in the money, you could as well, and that would enable you to sell a lower strike price. But again, you want to keep upside on your target in case silver pumps up into mid September, right? That makes sense?
Thank you, Nick. Yeah, of course.
No problem, Jose. No problem. Anyone else, guys? Any more questions at all? Anyone have any trades that they want to discuss or want some trade reviews at all? All right, guys. Well, then I guess we'll cut it short today, half an hour or so. Appreciate your time as always, guys. Hopefully you learned something. I'll be posting the video on YouTube if you want to review the slides. Hopefully I didn't mess up the recording, because that would suck. But if I did, then I'll have to re-record it, I guess. Either way, guys, have a great evening, and let's have a solid week ahead. Remember to trade safely, trade smartly, manage your risk, no FOMO, and let's make some money, okay, guys?
Cheers, man. Have a good one, everybody.
You guys
Thanks.
too. Later,
Thank you,
guys.
Nick.
Have a good night.
Thanks. How you going?
Thank you.
No problem, guys.